This is TreppWire Week in Review for week ending May 5th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of Siri and Advisory Services. This week, the Fed raised rates by 25 basis points, its 10th consecutive increase, but it did signal a pause. Still, concerns surrounding regional banks persist after the sale of First Republic to JP Morgan, and regional bank stocks continue to slide, with PacWest now exploring all options. In economic data, the job market showed signs of loosening, but very slowly. And of course, the monthly jobs number comes out Friday. Manus, the yield on the 3-month Treasury hit more than a 22-year high today. Clearly, investors are jittery.
It was a very, very strange week, I have to say. Let me start with the bank stuff. It was kind of crazy how hopeful and sanguine people were post the SVB collapse. The markets were rallying. People were optimistic. We felt like the crisis was contained. And that included right up till the Monday when First Republic got seized, even though we saw day after day after day of 20 and 30 and 40% stock price drops for First Republic. There was this narrative out there that this is contained. And right up to the moment when JP Morgan bought them and got a sweetheart deal, by the way, I think everybody thought we are in a risk on moment. And there was a delayed reaction. And once it kicked in, that reaction was severe. And it wasn't just limited to those 3 or 4 names that people considered rocky a month ago, PacWest, Western Alliance, and so forth. It extended to Zions and Comerica, which were both down 12% today. So the narrative in the banking space has turned 180. I think the three of us believe that that was the case. I think we thought that there was too much optimism, that we thought that there was another leg downward to this market, that not everything had played out yet. And that became the case this week. I do think that we will see more pressure for banks. I think we were way too sanguine for the last 6 weeks. There's a chance we get way too dire after this, right? We could see another 5 to 10 banks fail, but I don't think we're going to go down the 2008 to 2010 path where you have 300 bank failures. I don't think the commercial real estate problems will go that deep. We'll see. I hope I'm right. On the Fed side, it's that funny analogy where, you have a friend that's not being helpful when you're doing something around the house, and you say, don't just do something, stand there, right? You don't want them to get in your way. And I felt like there was a little bit of that with Powell this week. The statement out of the Fed was, we're going to pause, right? That was the written statement. We have reached the peak of rate hikes at this point, and the markets were up. And then Powell starts to speak, and all I could start to think of was, don't just speak, stand there, right? We've done all we need to do to get this market going. But he just basically pulled the rug out from under the we are done hiking narrative. The market was down the last hour on Wednesday, and now it was down sizably on Thursday. I think that he introduced a lot of volatility into the market, adding to what is already quite jittery. We have the debt ceiling, we have banks, and we have uncertainty about the U.S. economy. So a lot going on. Strange.
Wow, so Manus came out hot today. I think we've touched on a bunch of topics there. So let me kind of give you my thoughts on a few of those things, Manus. I would agree with you. It's interesting with Powell. He's been kind of leading the charge, and everyone's been waiting to hear what he has to say. And then to your point this week, it was almost like, do the 25 basis point hike. Don't say anything. Just let it be. Like, everyone knows what's going on. But he kind of doubles down on a few things. Like on banks, he actually said conditions have broadly improved. U.S. banking system is sound and resilient. And then you go into after hours trading with PacWest and these others, and like the bottom fell out. And it's like, you would have been better off just raising the rates and not saying anything. So I would agree, it's interesting. Like, saying, okay, well, yeah, we're no longer going to say we anticipate rate hikes, but we're also not going to say that we won't increase rates. Like the talking points were just a little bit mistimed in my estimation, given everything else that was happening. And I think Martha, adequately summed it up with just saying jittery, because I think that's kind of where everything is. And I would agree with you on the banking, sector on the macro as well, in the sense that, it's almost like everyone expected contagion to be immediate, that SVB went under, Signature goes under, and the fact that nobody else like fell apart immediately after, like, oh, okay, everything's good. But the reality is, if you're around somebody that's sick, you don't immediately start feeling sick. You might not feel sick for a couple of days, and that's kind of what I think we've seen here is there's some issues with some of these institutions, a lot of them caused by, people's lack of faith that deposits will be protected and other things that are maybe acting as an external catalyst to some of these runs. But we're going to see some more failures. Like, I think that's going to happen, but I agree with you. I don't think it's going to be in the hundreds. So it'll be interesting to see. I would also say, your perspective of, maybe it going the other way too quickly, of people being too negative. I think there's some real risk there, because if you just, doom scroll on Twitter or any of the news sites, I mean, it's like everyone has done a complete 180 in terms of what they feel about the banking sector. So it'll be really interesting over the next couple of weeks to see how that plays out. The debt ceiling is another thing. Like, Yellen comes out this week and says, oh yeah, by the way, we could run out of money like by June 1st. And everyone was just like, okay, like everyone either knows that they'll get some sort of temporary thing done, or at this point, things are so crazy, it's just like, whatever, like they don't even care. So I think we're living in some interesting times. If you had no context of video or seeing people and you just read the statements, you would be really confused by this week's market. The jobless stuff, private sector employment jumped by 296,000 in April, which was a 9-month high. That was according to ADP. And I know we have the jobs report coming out tomorrow. So it'll be interesting to see what that looks like as well. But jittery is a fair statement of where we're at. And I think, the next 3 to 4 weeks will be very interesting just to see how things play out.
Yeah, one thing I thought was very astute that was said on either Bloomberg or CNBC earlier this week, and I wish I could attribute it to the analyst that said it. And that is, everybody now wants the JP Morgan deal. JP Morgan came in, got a sweet deal on First Republic, and now anybody who was thinking about partnering like TD was going to do with First Horizon, or others might have done with Western Alliance or PacWest, are now saying, no. We're going to wait until this thing fails. And then we want the JP Morgan pricing. It's like those State Farm things. We want the Patrick price, right? We want the, right. We want the Jamie price for these assets. And so I think what that's going to do is going to put more of these banks under pressure, and more will fold more quickly. But I don't think that's the biggest story for CRE. I think the biggest story is that what we had now had with JP Morgan is price discovery. We will pay X dollars for these assets, some of them residential, some of them commercial, and you, the FDIC, are going to share in this risk with us, right? We don't know it at a granular level. We don't know how they came up with these numbers from the bottom up, but we've always said that selling begets more selling, and more selling begets lower values. And I think what we started here with this JP Morgan sweet deal is the process where these things are going to get reset, and reset quickly.
The price discovery discussion is going to get a lot more interesting over the coming month or so, because we're going to start seeing exactly what you've described. And that could be positive for the markets in the sense that at least you'll know what pricing looks like, and there can maybe be some activity, but it could also go the other way where you're saying lower prices, but get lower prices, but get lower prices, and you start a cycle that just takes a lot of things down that maybe otherwise would be okay.
Digging a little bit into First Republic, we've talked a little bit about how that possibly is a good deal for JP Morgan. Yes, they're on the right side of the trade on that one. But there were some problems that we noted in First Republic, and we took a look at some of their data from their call reports and some other information that we have through some of our tools to get a sense for what was coming that maybe nobody was really watching.
Yeah, it's really interesting. And when you're Jamie Dimon and you just acquired First Republic, like, you kind of don't want to brag, but you're like, look at what we just did. It's immediately accretive. And oh, by the way, like every year we think we're going to add this much additional revenue. And so it's an interesting position for him to be in. On the First Republic, in particular, the analysis, it's all these things. When you look back at them, you could do a little bit better analysis. In the moment, it seemed like, First Republic had a specialty in high net worth individuals. They come out in March and say they had access to about 70 billion worth of additional funding. Really didn't calm investors down. 11 big banks put in $30 billion to try to save them. To Manus's point a moment ago, we probably won't see that again because everyone's waiting for these to fall out and buy them at a discount. To your point, Martha, in terms of the data, we have a product called Bank Navigator, which aggregates a lot of really valuable banking information. So there were a few things that kind of jumped out at us on the First Republic Bank itself. They had high risk for interest rate sensitivity. They had high risk on lack of liquidity and weak earnings. And you put those three things together, and that paints a negative, dire picture for the institution. And then you lose public faith, and it just goes down very quickly. What's interesting, if you dig a little bit deeper into their balance sheet, their total assets, actually loans and securities, increased from Q4 22 to Q1 of 23, but their deposits plunged. So they saw about 160% negative decrease in their deposits. And so, I think that's the story we'll see play out with other institutions as well. If you look at their net interest margin, it was definitely squeezed by higher borrowing costs, minimal increase in their, interest income yield. So their net interest margin for First Republic was about 1.71% in Q1 of 23, which was down from 2.4% in Q4 of 22. And if you look at large banks overall, average Q1 net interest margin was about 3.46%. So they're about half. So not a pretty picture. But this is something that we could run an analysis on, provide data and information. We actually have the ability to create these type of summary reports across all of the lending institutions in the U.S. that have to report. We'd be happy to put something together if you're interested in this and show you what our capabilities are there as well.
Yeah, I mean, the one thing about the banks that I would throw in as a closing point is this, that in the past, where you've seen a lot of mergers and acquisitions has been in that big regional space. And what you have now is a situation where one of the big four can go in and buy a smaller bank and get margin expansion because they're buying something that's being valued at single digit X cash flow or lower than book value. And the minute it becomes part of that JP Morgan or Citibank or Wells Fargo suite, you have an immense value creation just because it comes under that too big to fail name. Now, the next 15 biggest banks don't have that imprimatur, right? They don't have that ability to buy a smaller bank where investors know that that regional may not fail, and therefore they get an immediate home run for buying these assets. I think that this Jamie deal might really be limited to those big four banks. The others are not going to have that kind of leverage to pull this off. We'll have to see. I'm not sure a North Carolina or Pittsburgh mid-sized bank will get the same boost that Jamie did.
Yeah, and I think if you look at it, like the FDIC was probably looking at all other suitors, trying to figure out a way to make that work so it wasn't Jamie's group that bought First Republic, and it turns out that they were the ones that got it. It's, the too big to fail banks got bailed out before, a lot of them, and now we're in a market where they're getting these things at a discount, and it's immediately accretive. So very, very interesting times in the banking space, and like you said, I think there's a lot more to come down the pipeline.
And pivoting to commercial real estate, we've published our CMBS delinquency rate for April. It's interesting. The rate was holding steady for last month, but there's some story underneath the covers there.
Yes, it's consistent with what people have been expecting and what we've seen playing out since the beginning of the year. We saw modest improvement from retail, hotel, and multifamily. Industrial was essentially unchanged, but another sizable uptick in office. Office, of course, is the part of the market that everybody's concerned about. When we go through our stories later in this podcast, it will become apparent why. And we're now up about 100 basis points in the delinquency rate for offices since the beginning of the year. So a sizable uptick, still under 3% for offices, but trending in the wrong direction, and something that I think will continue to trend in that direction for the remainder of the year at least.
Yeah, I think the other key takeaway here is lodging sector is still holding about the same. And industrial, I mean, pretty much exactly the same month to month over the last, call it 6 months. And so I think outside of office, the market's been really, really resilient.
And turning to office, we saw this story. Vornado had its earnings call this week. Prior to that, they announced they were pausing their dividend, which was a surprise.
Yeah, that kind of came out of the blue that they did that. But I think it's of a piece when you see Blackstone and Brookfield and others, PIMCO, closing ranks, if you will. Maybe that's not the metaphor I'm looking for, but when they start to give back properties, start to send assets to special servicing, start talking about no longer supporting assets, I think that they're onto something. And I think that, Vornado, very big New York City presence. And I think this squirreling away of cash is probably not the worst thing. I think that probably will give them flexibility down the road, but it did take people by surprise.
So yeah, on Vornado, if you look at their stock price a year ago, it was trading at about $38 a share. And as of today, it's hovering around $13 to $14 a share. Just to give some context on the dividend payouts, over the last 10 years, they paid out about $5.1 billion in regular dividends.
And one comment, Stephen Roth, the CEO, had some pretty fiery comments and was even going on the offense, looking at specifically the Pent project that they have, commenting that they're moving ahead with it. If you read beyond that, though, they're moving away from office towers and are going to start with apartment buildings. So interesting pivot there.
I think the underwhelming headline of 2024 will be all commercial real estate investors own apartments. It seems like everyone's getting into multifamily.
All right, we're going to dig through a lot of office stories. We'll start with, we've talked about San Francisco a few times. There was a story that was in ABC News 7, I believe it's their local station, talking about the impact of the vacant space. They've got about a 30% vacancy going on with office in San Francisco, which of course impacts property values, which of course impacts the city's tax base.
Yeah, I give credit to Lonnie because he's been harping on this for a couple of months now, how these reductions in values are going to really eat into the revenue base of the cities that are most heavily impacted. You have to think that San Francisco will probably be the worst, right? Their value is probably down more than anybody's, and we'll have a story about that shortly. But this comes from Liz Kreutz, if I'm pronouncing that properly. She uses the quotes, profound impact on the city budget. And I do think that that's really true. And it's not just the value per se. I mean, values being lowered does reflect itself in lower tax receipts and so forth, but other places also tap revenue from hotel taxes, transfer taxes, and other things. So it's not just the value itself that's going to crush these guys. It's everything around the fact that their ecosystem is just cracking, right? Especially in San Francisco. When you look at the headlines of the homelessness and the drugs and the crime and everything else, it's not an inviting city right now. I think you could probably say that about a few other cities as well. And when you get that negative distinction, it can kind of spiral out of control. People do not want to come. Restaurants sit empty, hotels sit empty, and tax revenues just collapse.
Yeah, I mean, the downstream implications, sales tax, hotel tax, as you mentioned, Manus, those are very real contributing components to the city's budget. But California is interesting because they have Prop 13, which limits the rate of appreciation on property value at about 2% per year, which you would say, well, that doesn't play a huge role here, except for when you see office buildings that had traded at 300 million a few years ago, potentially trading at 50 or 60 million this year, then that basis gets reset to 60 million. And even if the market takes off there the next couple of years, they're not going to be able to get that assessment up to fair market value. It'll be capped at 2% per year. So this is a long-term issue for them. And I think in the article, it actually says they're projecting the that the city budget will be slashed by about $250 million to potentially $500 million over the next 2 years. So real money.
So we have a number of stories that, man, as we've indicated, give some signs of benchmarks. We've got some transactions that might signal what pricing is at.
Yes, let me go back to San Francisco. I'll follow up on what Lonnie said. This was from Laura Waxman of the San Francisco Business Times. 350 California Street, I think this is what you were referring to, Lonnie, is being offered for $60 million right now, 75% lower than where that building was being offered only 3 years ago. Just an extraordinary destruction of value there. It was over 200 million, close to 250 million a couple of years ago, now being offered at $60 million. But that's of a piece in San Francisco where tenants are leaving, sublease space is growing, and all the stories seem to be negative. And I'll run through a couple more before we pivot to other comps. First Republic, this is also from the San Francisco Business Times, putting likely to put 750,000 square feet on the market now that they're out of business. They had 750,000 square feet in San Francisco. You have to think with this acquisition by JP Morgan, that will add to the San Francisco square footage. When you look at One Market Plaza, which might be the most concerning asset in San Francisco right now for us, a $975 million loan. This week, Visa announced they were giving back 200,000 square feet ahead of a lease that ends in 2026. Autodesk had already vacated. The lease there ends in 2026. And the top tenant is Google, who has a lease that ends in 2025. And if you're talking about something, this loan, by the way, matures in 10 months. This might be the single biggest benchmark we see in San Francisco, where value just gets decimated due to quality of life and tenants choosing not to be in the area. We already know Google is looking to give back space everywhere. I would say this is a prime candidate to be vacated in 2025.
Yeah, I mean, everything you just described, it's not things that I would associate being affiliated with San Francisco, given what we know about San Francisco over the last 15, 20, 30 years from a CRE perspective. I mean, it was a innovation hub, incubator for so many businesses, Silicon Valley. And, it's faltered from that reputation. I mean, if you're looking for a silver lining here, if you could buy a building that, 3 years ago traded for, in the hundreds of millions, and now you could buy that for 60, and you have the capital to persevere over the next few years, even if you didn't collect rent, I still think San Francisco offers opportunity into the future. At some point, locally elected officials and others will get everything squared away there. And I got to tell you, I'm in Texas and I love Texas, but I've been into California a couple of times over the last 6 months, and it's a beautiful state. I mean, every time I'm there, I'm just like, wow, this is an incredible place. And so I'm hopeful that they'll get it figured out. But the real destruction in value is going to be larger than what anyone expects. And I think it's going to be more prolonged than what people expect, just in the sense that we've never seen this volume of tenants vacating, the other issues that are plaguing the city all happening at the same time, same place. So I think this is something that will drag out for the next several years, unfortunately.
I totally agree. Moving on to another office comp we saw today. This comes from Cranes. It is of a similar nature to what we were just talking about in San Francisco. 300 South Wacker Drive was just acquired by Agave Holdings. They're the owners of Jose Cuervo Tequila, if I'm not mistaken. They acquired that property for a 40% discount to the 2017 price. So this is a 530,000 square foot building, 35 stories high, acquired by Golub and Alcyon Ventures in 2017. They paid $155 million for that and put in $10 million in renovations, and now are selling it, it appears, for $97 million, if the numbers are confirmed. It's rumored to be $97 million. So it's another similar story to what we are talking about in San Francisco, where another city with quality of life issues, in this case, in Chicago's case, aging physical plant of those downtown properties and real lowering of value.
Yeah, I saw some stuff this week that said, if you were someone that placed capital or a fund manager or whatever, you would never get fired for buying in the gateway cities. Class A office, Class B office in those gateway cities was kind of like how you kept yourself in your role. And unfortunately, it looks like those are no longer safe havens. And so it'll be interesting to see. What I think is interesting about that story is the Agave Holdings, that they're a Miami-based firm. And so, again, if you're trying to look for some silver lining, maybe they feel like the Miami market that's still really hot has priced itself out, and they're maybe looking for some relative value in some other markets, and maybe they found that here in Chicago. So time will tell.
We had a number of trading alerts that take us from subleases to move-outs.
Yeah, a lot going on this week. I'll try to go through them expeditiously. I don't want to spend any more time on First Republic, but we did put out a piece indicating where they have offices that might be at risk behind CMBS loans. If you'd like to see that, we'll make that a freebie. In terms of sublease space in Los Angeles, Netflix has put 100,000 square feet of space out for sublease in the Hollywood area. In Seattle, this is from the Puget Sound Business Journal. Microsoft is putting up another 500,000 square feet at the Millennium Corporate Park in Redmond, Washington. The amount of space that Microsoft has now put on the market in that Seattle Bellevue MSA is now over 2 million square feet. We also know that Tableau, which is owned by Salesforce, also has put more space on the market in that area, as has Amazon. So it's really, really starting to add up in that Seattle Bellevue neighborhood. This one, according to CNBC, Jennifer Elias, Google has halted construction on its proposed 80-acre campus in San Jose. The article says that sources close to the development have indicated that they don't plan to revive this campus anytime soon. So again, part of a theme: Microsoft in Atlanta, Amazon in the Virginia suburbs, Amazon in Seattle, now Google in San Jose. People pulling back the reins on big development projects that they thought were going to go through a couple of years ago. I think it's all very troubling for the market. It's almost like, I was talking to a reporter this week, it's like a tug of war where for the last 5 to 10 years, Amazon, Google, Facebook, Microsoft were all on one side of the rope, pulling as hard as they could. And they were pulling the entire rest of the market higher in terms of rents, taking up space. So they were pushing availability down. They were a huge tailwind to the landlord community. And what it feels like today is they've dropped the rope, and those landlords are now falling in the mud. And it's not a good look.
Yeah, it's interesting. If you go back and listen to our podcast, probably around January, February of this last year, man, as you and I kind of went back and forth on, what are these tech companies doing, signing all of these new leases? I mean, like, we had multiple stories, green shoots then of, Meta, Google signing hundreds of thousands of square foot of space. And it didn't make sense to us at the time, but we assumed that they knew something we didn't. And obviously that hasn't played out for them. I'm not good at math really, but if you just start taking millions of square feet and dividing it by the average lease size in those markets, it's a really long time for these buildings to get filled back up. And that's assuming that you have companies that are not named Microsoft and Google that want to come in and take down those spaces. And so that might be an interesting piece for us to look at is, the average lease size in some of these markets, because to me, this is a years long problem, because you're not going to have these big players coming in and taking down 200,000 or 300,000 square foot. The one good thing here is if you're a tenant rep, this is probably the best time of your career for you to go in and negotiate favorable terms for your clients. And if you're a tenant rep and you're not using our products, you're definitely missing out. So cheap product plug there. You should reach out to us because we have a lot of really great information that could benefit tenant reps in this market.
Lonnie, dusting off the shameless plug. We haven't done one of those in a while. Good for you, Lonnie. One more story we'll talk about in California, and then I'll bring up a couple of brokers start your engines. In Los Angeles, this is the Wilshire Courtyard property, which is an office, not a hotel that gives you free breakfast in the morning. They got a big boost a couple of months ago when Sony Pictures took 225,000 square feet at that particular office. We thought things were on the uptick. Occupancy had fallen considerably over time. It was a loan of concern for us. Sony made us feel a lot better about that particular asset. But this week, we reported that media brands worldwide and Skydance Media were both expected to vacate their leases in a size combined, which almost in full negates the Sony addition that we got earlier this year. So this goes from a positive story back to one that we're watching very closely. Occupancy was expected to go back above 70% with that Sony lease. Now with these other two vacancies coming up, I think it's going to be back in the 50s. So another office to watch. Lonnie, do you want to cue up the engine?
Yeah, let's prime that bad boy. Let's pump the gas a few times and fire it off.
And see, Lonnie's doing that dance, the lawnmower where you're pulling on the chain right now. He's getting the lawnmower going. Here we go. This is from Bloomberg. They are reporting that Nomura could be on the hunt for new office space. The firm is currently located at Worldwide Plaza. That's on 8th Avenue. They have 700,000 square feet there, 34% of the GLA. Their lease ends in 2033, but they do have some partial termination options. They are looking to move to a smaller space, so something more in the 500,000 square foot range, something to watch there. In New York also, Steve Cuozzo of the New York Post, this is an intricate one. He says that Paul Weiss, which is a big law firm at 1285 6th Avenue, is considering a move. Among the places they're considering is 1345 6th. They too are looking to downsize by about 25%. However, both landlords are keeping an eye on UBS/Credit Suisse. Those two firms, having merged, have duplicate space. There's a question as to whether the combined entity will stay at 11 Madison or will stay at the 6th Avenue location. And for now, a lot of moving pieces. So if you didn't see Steve's piece, he does excellent coverage of the New York CRE market. Take a look for it, because that might be an opportunity for our well-heeled brokers out there.
And I think we should go to Houston, because we've got probably 3 stories out of the Houston area that are worth mentioning.
It's been a very active week in Houston. I'll start with this one. This comes from the Biz Journals. LyondellBasell Industries is moving from 1221 McKinney Street in Houston to 2800 Post Oak. So that's kind of a mixed green. On the positive side, they're not giving up their space entirely. They have a modest downsizing, to be sure, but it is, what is one landlord's gain is another landlord's loss. Kiewit, this is a out and out green shoot. They've increased their presence at Energy Center 1 by over 100,000 square feet. They now have over 275,000 square feet at that building at 585 North Dairy Ashford Road in West Houston. And lastly, we have 2 more. Technip Energies is moving within the energy corridor, another mixed green here. They have signed a lease for the top 6 floors at West Memorial Place 2. They are moving from Energy Tower 2. So a lot going on there. And I think, Lonnie, you may have one more that I can't pronounce the name of.
Yeah, I love that Manus is tossing the one over that none of us know how to say. Just to piggyback on that last story, the building that Technip is leaving is going to set that occupancy at about 10% occupied. That's according to JLL. So definitely not a green shoot for the previous building owner. This last Houston story comes from the Houston Chronicle by way of Marissa Luck. So that she talks about construction and engineering firm Fluor, that's Fluor for those wondering, that they're moving their Houston area office to the energy corridor. So they were in Sugar Land, Texas for about 40 years, and they're now moving over to the energy corridor. Kind of an interesting story here. They had built their current office back in the mid 80s, around 1984, with hopes of filling it up with about 5,000 people. It was a 1.2 million square foot campus, and they've stayed there for almost 40 years. But now where they're moving basically has room for about 1,600 employees. And so it'll be interesting to see. They're about 308,000 square foot of space that they're taking down. So, what is a 1.2 million square foot campus built in the 1980s sell for in Sugar Land, Texas? I guess we'll find out. But potentially for the energy corridor, a 300,000 square foot lease that's guaranteed, 12-year term. This is at 3 Eldridge or 737 Eldridge Parkway. And so good news from that perspective. Bad news if you're in Sugar Land and now have to commute into the city to go to work.
We've got a few more property sectors we can try to get through. We will start with multifamily.
Yes, we had some good stories, some not so good stories. We'll run through them all. I'll start with the good ones. There's this notion out there. You see the headlines all over the place that volume is down considerably, sales volume, refinancing volume, et cetera, down 70, 75%. And I'm sure that the people putting out those numbers, they're accurate, but there are some big stories out there, some big sales taking place, and I'll run through them very quickly. In Boston, we saw Church Park, the Church Park Apartments on 221 Mass Avenue in Boston, sell for $439 million this week. That's $865,000 per apartment for the 508 unit complex. I love the way the press describes this one, by the way. I wish I had come up with this name for architectural style. Brutalist. They said the brutalist version of this building, Church Park Apartments, sold for $439 million. I like to be blunt, but that's even blunter than I've ever imagined. But that was acquired by Brookfield. So 439 real money. And then, I don't always throw the tough pronunciations over to Lonnie. So I'll take this one. This is the
Stallo
Tower in New York. It sold for $403 million. This is a 322 unit apartment on 2nd Avenue. The buyer was Black Spruce, and that price goes for $1.25 million per apartment. So 2 good stories there.
Stallo.
What is that? Solo.
It's my pronunciation tool. It's a website that allows me to click a button.
Funny.
Manus is using the underground version of ChatGPT that also does a pronunciation.
Very funny.
I'll send you the link later. On the not so positive side, a couple stories here in Chicago. The Lake and Wells Apartments. This sold for $98 million, $298,000 per apartment. Why did this catch our attention? That sale is down from what was estimated to be a $123 million development when this thing was built about 15 years ago. So we're seeing that at about 25 million less, about 20% less than what this thing was valued at about a decade and a half ago. In a similar vein, I want to throw this one out there just to give a sense that values are starting to come down. This comes from the Washington Business Journal, Tristan Navera. The Sussex at Kingstown. This is a 556 unit apartment in Fairfax County. This has sold to Boston-based asset manager GID for $136 million. Why did this catch our attention? About 5 years ago, this property was sold for $144 million. So what we're saying is that, from 2018, when this last sold, to 2023, we saw a huge run up in value. Now what we're seeing is this thing selling for about 5% less than what it did 5 years ago. So we've, at least in this one anecdote, and of course, one property doesn't a market condition tell, but in this one case, we've gone more than round trip. The value has retraced its value and then some from where it traded in 2018. So, and this is the Sussex at Kingstown Apartments.
Yeah, it would be interesting on that one, man, is to see, did the revenue, on the rental side, did they just not capture the upside that a lot of these other apartment communities have over the last few years, or were they successful at growing revenue, but the expense creep that's happened across the spectrum has really caught up with them? Or did cap rates just stagnate or maybe expand in this market some? So you're basically, whatever income gains you've had have been negated by increasing cap rates and cost of capital. So Manus, on that property, we actually do have some information on a previous loan that was taken out on the Sussex at Kingstown. Interesting nugget here on a lot of the multifamily properties in our data set, we've actually developed a Trepp automated valuation model where based on the financials and market trends in that area, we actually put an estimated automated valuation on the property. And so in this example, the Trepp AVM on this property would indicate a value of about 143 million. And you just read through that it sold for about 137 million. So pretty close on the AVM side from the Trepp perspective. And if you look at the actual financial performance for this property, it actually did see a pretty significant increase in revenue year over year. So like in 2019, it was producing about 12.3 million in effective gross income, grew to about 12.9 million in 2020. And then through 2021, it was 13.3. So pretty significant. We only had the first 9 months of 22, but it was on pace to exceed the 21 numbers as well. So, and it actually translated into NOI growth as well. So 7.5 million in NOI back in 19. Fast forward to 21, it was at about 8.4 million in NOI. So this may be one where you just see some stagnation or expansion of the cap rate, which led to a lower sales price in this particular instance.
Shout outs. We have a few, and I'm going to abbreviate some of them because otherwise we'd be here for a while. Michael B. on LinkedIn. And we had a number of people request our loan to deposit report. I would say more than I can mention. So thank you for those folks who reached out to us to ask us about that. We met some great people when we were out in Detroit. Greg N., RJH, Audrey H., Naman I., Jeremy C., and Ashish V. They were very kind to us when we were out there, and we had a good time. So thank you to all of them. David E. on Twitter, listener, I think he's now a client. He said now that he's looking at the Trepp information, he sees why everybody looks at it. So thank you for that. Arthur H. on Twitter shared our top 10 banks by CRE lending graph, and there was a lot of chatter on that. John H. on Twitter, great pod from earlier this week on the outlook on Detroit. Tino T. left us a review on Apple Podcasts. It said, wow, just wow, and said a bunch of other great stuff. So thank you. Jonathan P. on Twitter commented on an event Lonnie's participating in New Jersey. They should record it and we could turn that into another pod. So maybe we'll do that. Buddy C, great work. Our own Mike B, another great podcast. The one in front of a live audience was great. Oz reached out to us on our delinquency. Jonathan F for slides on our ICSC presentation. Andy O on Twitter, and people that were interested in our retail and QDR report that we have just put out. And Extreme RE Investor at Pearl Mike on Twitter suggested our podcast. So if I've overlooked anybody, my apologies. There were a lot of folks that we had to reach out to.
And Martha, I know you're probably going to do this, but I just wanted to give a shout out to our host, Emily from Detroit, when we were there last week. Incredible person, incredible hospitality, put us on in a great event, but her in particular, just really great. Sometimes you meet people and you're just drawn to them and you just know that they're just a good person and that they help a lot of people. And Emily definitely checked those boxes.
Yes, she's one of our favorites too. And I know if Manus doesn't have his normal spring in his step, it's because he's mourning the Rangers loss. And I think he's going to have to go with another team.
It has been a brutal week. I got to say, the Rangers went down barely with a fight. It was a whimper at best. The Mets go into Detroit. I got to say, last week when we were in Detroit, the hospitality was extraordinary. The people were so warm and welcoming. It wasn't such for the Mets this week. They got swept by the Tigers, and it just broke my heart. You guys at Detroit, you had me. You had me until this week.
Yeah, I wonder, did your family throw any shade at you for wearing the Red Wings jersey and say maybe you put a jinx out on the Rangers?
Well, they had lost the previous two, so I figured I was really looking to change their luck. But a few of them did call me a heretic, I have to say, and that was a little bit tough.
You know, Manus, you can always cross the river and become a Devils fan. With that, we'll close before Manus jumps through the monitor here. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.